presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak Market Wrap YouTube update for November the 27th, 2023. I'm Mo Ansari, President of Compak Asset Management. I hope all of you had a wonderful, wonderful Thanksgiving. It's my favorite holiday. It's Christmas presents and all of that. This is just family. It's always fun to see everybody together and have all the family discussions. You know what they are. But anyways, don't forget, go to the media page, log into that, and you can subscribe to all of these. You can get the YouTube update. We can get the weekly Market Wrap podcast that I do now. You can get all the emails, all the letters, that the weekly Market Wrap Market Minute letter. You can get all of that information. All of it is free simply by going to compak.com/media and subscribe to this so you'll get the weekly update, or whenever I do this update, you will get that. Looking at the markets, last week, market was up just a little bit over 1%. Quarter to date, so far this quarter, we're up more than 6.5%. Year to date, S&P up 20.5%. That's been an incredible year so far, a lot better than everybody. And when you look at the last 3 years cumulative, even with last year's decline, we're still up 31.5% nearly for the last 3 years. So things are really been a much better year than everybody thought for the market. Again, as I said in July, I think the Fed is done. The big news will be this month will be the Fed meeting the FOMC. And if they come out with a dovish statement saying finally they're done raising interest rates, and then everybody will start focusing on when they're going to start cutting rates. I think that'll depend on how we see the economy slowing, which it is not. It's still going along very, very nicely. And then the soft landing scenario will start to come back in, and that's what everybody will be talking about. Healthcare was one of the best sectors last week. That did the best. It was up 2.3%. Consumer staples, communication services. When you see technology, it was way down here. So we are starting to see some diversification, some broadening out of the market, which is a very healthy sign when you look at it. When you look at the bond rates continue to come down. As we said, our projection was in July that the 10-year would go to 4.93 to 5.03. We topped out exactly at 5%. And since then, we have come all the way down on the yields. And so we are starting to see the 10-year down to nearly 4.5. It's nearly come down 0.5% already, with the anticipation that the Fed is done raising rates. Last week, oil again was down nicely. When you look, it was up slightly off the 77 low. So I think it's still looking pretty good overall. When you look at it, it's still now it's in the 77 range, and that's way down from what everybody was expecting. Gold has come up nicely. Silver, I think, is at a breakout point. If it can get above $24, that would be good. Copper has come up. When you look at it, it's not that far above where it was last year. But you look at commodities overall, they have stabilized. December usually is a good month for the market. The last 30 years, 75% of the time, the market was positive in December. So that is a positive sign for the market. Plus, we've got a tremendous amount of cash still sitting, and we are going to get FOMO, fear of being left out of the market, and fear of missing out, as it's called, where people are sitting in cash and realizing what they have missed. This week, we do get the consumer sentiment. It has gone up from 60 to 61. Durable goods were down, basically because of the auto strike. Existing home sales dropped 3.79 million from 3.95 million units. Again, just not enough homes for sale. As I've said all year long, from the beginning of this year, I just don't think that people will be selling their homes because nobody wants to sell a 3% mortgage and get a 7% mortgage. And that's why we're starting to see not enough inventory out there. builders themselves are very cautious because of the high interest rates. They don't want to be caught in a 2009-10 sort of situation where they overbuild and be left with inventories where they have to take losses. We do get new home sales this week. We get the Personal Consumption Expenditures Index, the PCE as it's called. That is what the Fed looks at as the inflation gauge. Then we get the third quarter GDP. The big event this week is the PCE. Next week will be the unemployment data, which I think could come out stronger than expected because we're seeing the UAW strike ended, and we could see all of that coming back into the unemployment data and bringing unemployment down, which will be a temporary phenomenon. Looking at the technicals, we've got resistance in the S&P at about 4607, and that is the high for the year that we made in July. If we can get above 4607, we're trading right around 44, 45 and a half right now. So if we can get above that, the projection, the Fibonacci projection from this high is 4684 to 4732, which we could get there if we can once get above 4607, make new highs for the year. Support is at the 20-day moving average. Again, we're in a third wave, so we should see a fourth wave pullback somewhere before we go back up to the fifth wave high. So I think overall we're going to see that. Looking at the weekly chart, again 4607, and then the all-time high, which was beginning of last year at 4818 is what I'm looking at. But the projection from this high, if you project a Fibonacci, it comes to 5,000 to 5150, but that might be a year and a half away from where we are now. Looking at the 20-week moving average, we're 4412, 50-week moving average 4430, 4239, and then the long-term moving average at 4169. So again, market looks very good. We went through the August-September pullback. That scared a lot of people out of the market, and now we're starting to look at the overall market, and it looks overall pretty good. NASDAQ, again, the high of the year is going to be that 4,446 or so, or 4,450. We're close to that now. If we can get above that, that would be very positive. Projection from this to the Fibonacci is 15,475 to 15,675. That's the projection we get for a high. But first, we are in third wave, fourth wave pullback somewhere, fifth wave high from there. Could be a couple of months away. Again, my dot plot, as I say, this is a long-term weekly chart. As you can see, it goes back to 2020, about 3 years back. So each one of these lines is 1 week of trading. We look at my dot plot. As long as the market is above the dots, it's in a bullish phase, and below the dot, it's in a bearish phase. And you can see that we hit the dots, and now the dots are down here. So we have turned into a bullish phase, and usually it lasts at least 6, 7, 8 weeks or longer. You can see once you're turned up here at the beginning of last October, you can see that lasted quite a bit of time until we came to here, which was August or September of this year when we turned down somewhere right around here. And then we came down, and now we're going back up. Target, again, 14,450. That's the high this year. Then we're looking at we're looking at the all-time high on the NASDAQ, 16,212. That's the all-time high, but the projection from this high comes into 14,840 to about 15,000. So if you can, this is wave 4, and this will be wave 5. That's what we're looking at on the weekly chart so far. 10-year note, interest rates topped out exactly as predicted. We were looking, not everything works that well, but we had this projection for about 4.93 to 5.03. We topped out exactly at 5. We're down now to 4.38. We could get a bounce to the 20-week or 20-day yield of 4.5. 50-year yield is 4.64. I think it depends on what the Fed says at the meeting next week. At the beginning of next month, the middle of next month is what we get from the Fed, and I think that's going to be something critical to watch. Do they get a little bit more dovish? And if they do, that could propel the market. Crude oil topped out at that 95 level. We're back down to about 75 now, trading right around there. Wave 1, 2, 3. We should get a fourth wave bounce, which could take us back up to about 78, which is the 200-day. But as you know, technicals do not work very well in oil because it's all based on fundamentals. If Saudi Arabia decides to cut production, price will go up. There was some dispute. They canceled the OPEC meeting, and that did put some more pressure. Seems like there's some acrimony as far as OPEC is concerned, how much they want to cut, who has to cut. Saudi Arabia, I think, is getting a little tired of carrying the weight and cutting the most. Gold market looks a lot better since it made the fifth wave bottom right here. We've seen wave 3, wave 4 pull back to about the 200-day. Now we're coming back up. This projects to about 2040 or so right up here. That's the projection from this. And then the all-time high that we've seen at 2085. I believe that the market gold could go to 2085, if not higher. Those are my views. Those are my thoughts for this week. Don't forget to tune into the podcast, which is a 1-hour broadcast or a much more detailed podcast that I do once a week, every Monday. You can get that, and you will get that by just subscribing to it. Those are my thoughts. Look forward to talking to you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.